Welcome back. You're watching our special series, Asian Tigers. I've been in conversation with Jonathan Garner of Morgan Stanley. The other important thing which will happen as your earnings expectations play out is that we get into another election cycle coming. Through the next few months or quarters, we've got a series of state elections in India leading up to the big central election. Is that an important influencing factor for the Indian market, you would say?
Yeah, I think it is important. I think a lot of policy progress has been made recently. And I think investors would, in terms of markets generally, not just India, they tend to like policy stability. So we'll obviously have to see what the people decide. But in that regard, I think investors have been broadly comfortable with the policy direction of the current administration.
Let me just ask you about the point you made about materials, just to get back to earnings. Is your view on commodities basically constructive for for the foreseeable future, global commodities?
We've done quite a lot of work on the supply side reforms in China, the capacity discipline, and in sectors globally facing sectors like steel, iron ore, coal, that there's more pricing power, we think, than in the past. And that does spread through even to copper and aluminium. I think oil, we touched on earlier, is a more difficult one to call and is much less influenced by China's supply decisions, clearly, than some of the ones I just mentioned. But in general, we think commodity prices will remain reasonably firm, and that should benefit the upstream materials names.
What about gold? Given the marked lack of volatility in global markets, do you think gold has another underwhelming year ahead, or do you expect volatility to come back?
Well, we're not currently recommending gold stocks in our portfolio. We do sometimes from time to time in the cycle. But in terms of things that drive gold, particularly monetary cycles and real interest rate cycles, it's not an area that's particularly attractive to us right now.
You spoke about many triggers for the Indian market. Let me ask you about one, monetary policy. For the last couple of years, while we haven't had great earnings support, periodically the Reserve Bank of India have been cutting rates. But now with the price of crude, the expectations of the US Fed, etc., do you think it's unlikely that that will be a major tailwind for far greater interest rate cuts in India?
Yes, at the moment we do have, in our view, RBI on hold for really quite a considerable time at the current level of interest rates. And again, we touched earlier on oil and also on the Fed. I think that does limit any likely interest rate reduction. So we're not looking for any sort of particularly dramatic, let's say, monetary policy easing as a catalyst for equities. It's much more on the earnings side that we're looking at things.
And this global cycle that we are witnessing right now, do you see that essentially as a nice cyclical patch, or do you think it can run on for 2-3 years from here on, the synchronized global recovery that we're witnessing today?
Well, our economists would date this to the beginning of 2016, and they think it lasts at least through 2018, but nothing good obviously lasts forever. But yes, it does seem to be the most synchronized upswing and the strongest synchronized global upswing since the 2003-06 period, so that's great.
What's the central risk, Jonathan, to you? You spoke about crude, of course, in the Indian context, but what worries you about this scenario that you're talking about right now, which is good global growth, reasonably good performance in global equities, India moving in sync with that? What can upset this apple cart?
Well, I think oil is one risk. We've already talked about that. Were we to get supply-side effects in terms of sudden sharp moves higher in the oil price, that is more negative for emerging markets and would be more negative for India than for the average developed market. I think if you look at inside the developed markets, if you look at, say, things like spreads on riskier debt in the junk market, they are tight to history. And we have pockets of excess in the parts of the corporate credit world, in the developed world, which warrant careful monitoring. China itself has surprised on the upside with growth and is a key driver of global growth, and its growth will probably roll over at some point next year and soften, so we need to monitor that. There are always risks out there, but it's trying to weigh up the balance of risk and return here, and in that context, India is a solid overweight for us.
Do you see this whole US tax debate having the potential to roil markets very significantly, because the debate seems to be getting more shrill out there? Could that precipitate a significant US correction which has any fallout effects in the rest of the world?
Well, it could, but you sort of asked me a sort of a triple hypothetical there, which is like if something bad happens in the US and there's a correction, you know, what would happen? We don't tend to like to answer questions of that nature. I think, yeah, it's more of an idiosyncratic problem to the US. At the moment, we're anticipating that some kind of tax reform will go through involving about 0.5% of GDP fiscal injection to the US at some point next year, heavily focused on corporate tax reduction. To some extent, that's in the price. I don't think it's a particularly large market influencing factor in our judgment, certainly not as relates to the other factors we talked about at the domestic to India right now.
What do you hear when you speak to large investors into the region, emerging market investors? Because, I mean, there was a time when emerging market investors seemed to have a slight air of disappointment about them for the money that they'd put to work earlier. Has that dissipated a bit? Do you see more interest right now? Or is it still a lot of very cautious kind of optimism?
Well, we've got about $70 billion of inflows to emerging market product year to date. It may not feel like a great year for EM inflows to you in India because the positioning on India has adjusted somewhat more negative as people have put a lot of money into North Asia. Yeah, I mean, it's been a strong year for flows. And if you look at global investor positioning generally, they're actually neutral emerging markets in a global context for the first time since 2010. So the extreme bearishness about emerging markets of, let's say, the 2014-16 period, that's definitely gone away.
The earnings recovery story that you're talking about in India, is it consistent with what you're seeing in the rest of emerging markets? And does it come accompanied with a significant jump in return in equity as well in these markets? Because that often is an important determinant as well.
Well, it's coming a little bit later in relation to India than elsewhere. And that's partly why we've seen this rotation away from India to other markets that has surprised more on the upside in terms of earnings near term, particularly China and some of those semis plays in Korea and Taiwan. But in relation to corporate ROE, India still has a very strong story that over the cycle it has a far higher than average ROE in an EM context and pretty decent long-run dollar EPS growth over the cycle. So, yeah, if we're right on our diagnosis of these temporary shocks rising from demonetization and GST, if we actually get the growth acceleration our economists are calling for, if we avoid an oil shock, then India will come through with very strong earnings growth relative to EM over the next couple of years, far higher than we're predicting for EM overall for the F18 and F19 years.
Jonathan Garner, always a pleasure. Thank you very much for joining in today.